This is one of my favorite parts of the course, when we actually go out and do hands-on research and analysis of individual properties. We call them case studies, and I'm going to show you a 4-step process that is really going to accelerate your understanding of the asset class by way of doing real-world case studies and then changing your assumptions, comparing properties, comparing different assumptions, and watching the way the tools that we're going to show you can sing for you and project possibilities out into the future. So the first thing I did is I went to a brokerage website and chose a property. And I'm doing this 3,000 miles away from where I sit because I want to show you how, with the resources on the web today, you have an unprecedented ability to look at the national marketplace as a smorgasbord full of opportunities for you to generate cash flow and build wealth. So I went over to Long Beach, California, where one of our OwnAmerica certified agents, who's become a friend of mine, operates. He's taught me a lot about Long Beach, and I randomly chose a 4-family house in Long Beach, California, 1474 Magnolia Avenue. The asking price of this property is $400,000. And as I scroll down, one of the reasons why I liked this listing is that the listing agent did a fairly good job of sharing with us what the 4 units are renting for. And they used exact numbers, so not round numbers, but more specific numbers that lead me to believe that there are actual leases in place here with real tenants. Again, I'll obviously check more closely, but for the purposes of a distance case study, these numbers are encouraging. And they give us an estimated net income. So I'm going to use these numbers, but I'm going to trust but verify. So first, I jot down some of the information on this property. Then I'm going to bounce back over to the screen here, and I'm going to click on the rental analysis website because I want to confirm those rents with a source that's trusted, in addition to working with a local broker in the market who is going to be the most trusted source to tell you exactly what's happening in that local marketplace. There are resources like RentRange.com that allow you to punch in something very simple. Put in the zip code 90813. And there were 2 2-bedrooms and 2 1-bedrooms. So I'm going to change this to 2 bedrooms, and I'm going to click Get Rental Rates. Now, RentRange happens to be a very detailed database where they pull in property data from all kinds of sources. You can read about how they gather their data, but they are a trusted resource for major national REITs and things like that. So they're a professional resource. And what it shows is they found 126 matching results within a 1-mile radius. And it shows here a low, median, and high. Now, the rentals that we just talked about were 4 properties, the biggest one at $1,210 a month, and the second biggest one at $912 a month. So what that tells me is, based upon that information, this rough gauge here tells me that those rental numbers are actually pretty good because both of them are either at the median or even below the low level, according to RentRange. And then I'll go and I'll put in the same zip code for a 1-bedroom, which on our subject property, the rents are $850 a month and $775. And so again, I get some comfort here that $850 is in the range of median and $775 is actually in the range of low. So if both of these were on the high side, it might make me nervous. This gives me some comfort that I've got some accurate information. The third thing I'll do is go to our patented case study calculator, which is a feature that we built here at OwnAmerica to enable you to put assumptions in and then forecast possibilities into the future. So first, our purchase price, I'm going to put in the asking price of $400,000. I'm going to put a down payment of 30%. And so $120,000 down payment might seem high, but that's the right way to buy investment real estate. I'm going to put in $15,000 in closing costs. My mortgage amount calculates for me, and I'm going to put 6.25%, a little higher than what's available today, but I'm being conservative. So the first thing you see is that I've got 3 charts on the right-hand side here. I've got investor equity, cash flow, and rate of return, or IRR, internal rate of return. As I fill these numbers in, these charts are going to populate. So the first one shows me a line that shows the property value staying stable, or stagnant, I should say, at $400,000, but my mortgage payments are building equity by virtue of amortizing my loan. So I can see out into the future that I'm building equity each year by virtue of paying my mortgage down. But now the system asks me for an annual appreciation rate. Nationally, the American housing market appreciates at between 3 and 4% per year. When we go above the trend line, as you've seen, that's something that has to be corrected. And when we go below the trend line, after, say, a major correction during a deep recession, we're going to rise back up to the trend line. If you buy in a place that is being hurt by the recession and therefore has good upside potential, if you buy in a place that has good migration trends, good job growth trends, which elevates your values in the future by virtue of elevating demand, if you buy a property that you're getting for a very good price, all of those things will lead you to believe that you'll be able to achieve a good solid appreciation in the future. So I'm going to put just 2% and be very conservative and watch what happens with my investor equity chart. The top line rises. And so if I'm looking at this thing as a 10-year hold, I'll go to 2022. My property value in 10 years is just shy of $500,000, so it's appreciated by $100,000 over 10 years. And I've got equity that has gone from my down payment of $120 plus my closing costs. So my money in was $135. My equity is now $265. Again, these numbers are not guaranteed. When you sign on to this for the first time, you're going to have to acknowledge that you are playing with a tool here that projects into the future, but none of these things can be guaranteed. But it is designed to show you how the interplay of these different factors work to create wealth in real estate. Now I'm going to go to the cash flow analysis. We've already established that the rents in the system were fairly accurate according to the market rents, and that was a total of $3,747 a month, which translates to about $45,000 a year in gross income, annual gross income. And you see my charts are beginning to change again now. I have to put a vacancy rate in. And again, we recommend that you have a professional real estate agent helping you keep tabs on your leases and helping you make sure that your tenants are required to give you notice at least 60 days in advance of vacating, which allows you to get on the stick to get another tenant in there and keep those vacancy rates down. So I'm going to put a 5% vacancy rate in here. That calculates my effective gross income, which is my annual gross minus my vacancy rate. Now I have to put property taxes and operating expenses in. So I'll put in $12,000 in property taxes. I'm going to put in $1,500 in insurance. Legal fees I'll leave alone. Maintenance we'll call $250 a month, so $3,000 a year. I'm going to assume that every 2 years I have to re-rent an apartment. $1,600 a year I'll pay in commissions. Utilities I'm going to have be the responsibility of my tenants, and then other, let's just call it another $2,500 to be conservative. And I click save. And you'll see now that my cash flow statement is showing that I've got a positive cash flow of about $1,400 a month. Now it just so happens that in the MLS listing, it showed that the net income of this property is $3,415. And so I'm going to ask that listing agent to have the owner show me how they came to that number, because my conservative estimates have got me profiting at about half of what they're telling me the existing owner is generating. So that's good because I'm being conservative. But now I've got some projection numbers. My annual rental increase. We're going to recommend that you have built into your leases an annual rent increase for your tenants of at least 2%. So if I put 2% in there, you see my cash flow chart really improves. And then if I say that my expenses are also going to increase, and I'm going to say that's going to be at 1% per year, and again, all the charts move. Now, of course, you'll notice that the investor equity chart didn't change based upon my cash flow analysis, because that is based upon what the property is worth minus what my mortgage balance is. It has nothing to do with my monthly cash flow. But the cash flow statement obviously changes, and it starts off at that $1,462. But because of the growth of my rents and the lower growth of my expenses, I can see my profitability growing year by year. And depending on how long I plan to hold this property, I'm going to make more and more money as the years go by. You can see here that subliminally, we're pounding this idea into your head that you're doing this for the long haul. So all of our charts are set for 30-year holds. You're not going to hold everything for 30 years, but you want to be able to project your family wealth when you hold these properties for the long term. And then finally down below, the rate of return. This is like getting a bank statement or an investment statement, the kind of things you get when you own a mutual fund or have an investment account with a Wall Street firm that you never really get with real estate. one number that wraps in how much you invested, how much you've paid down, how much your property's appreciated, plus and minus how much money you're generating in cash flow and your expenses, all of those factors wrapped into one number, the internal rate of return. And if you hover over this line, you can see that over time, this is producing better than 9% internal rate of return. So I'm going to jot that down, 9.1% in 10 years. And so I've got a baseline now that based on these assumptions, I'm looking at a 9% internal rate of return. But what if I am buying with impeccable timing? What if I am buying in a place that I've researched thoroughly and I believe that I'm buying an under market valued property in a market that's being depressed right now, but in a place that has great long-term potential? So instead of getting that only 2% appreciation rate, I actually get 3%. Look at what happens to all my charts, or at least my investor equity chart. Now in 10 years, I've got $322,000 in equity. Let me go back and show you. At 2%, in 10 years I had 265. At 3%, I've got 322. So some $60,000 more in equity based only upon the fact that I have 1% more in appreciation per year on average. What if instead of a 2% annual increase in my leases, I'm able to get 3%? But before I do that, actually, I want to go down and look at my internal rate of return. It was a little bit better than 9. Now it's closer to 11. So based upon 1 percentage point of appreciation, my internal rate of return is jumped by almost 2%. Now, if instead of a 2% annual rental increase, I see a 3% annual rental increase, my cash flow improves, my internal rate of return has now gone to 12%. So again, by virtue of researching well, buying well, and managing my tenants well, taking my baseline of conservative assumptions, I was looking at potentially a 9% internal rate of return. By doing a little bit better, still less than the national average of appreciation, and managing my tenants better, I'm looking at a 12% internal rate of return. And now for the fun of it, I want to see what happens if I actually beat the national average and do a 4% annual appreciation. Now, in 10 years, I've got $384,000 worth of equity, and my rate of return is now north of 13%. This, by the way, are the kind of results that professional investors get when they follow the kind of things that I've taught you here. They do their homework and they stay diligent about treating their real estate like a business. This is why people who invest in real estate get wealthy, because the combination of those drivers of wealth, the appreciation, plus the amortization of the loan over time, plus the positive cash flow, all bundled together give you a stable investment that produces much, much better returns than any other form of investment out there. So once again, I'm going to disclaim that everything I've shown you here is conjecture. Okay, you're taking a chance when you invest your money in real estate, but it's a chance that I'm always willing to take, because the more you do this, the more you begin to understand the moving forces that drive wealth in American real estate.